Hi guys, thanks for tuning in to another episode of Nuggets News. Today we've got a special returning guest, and that's Martin North from Digital Finance Analytics. How are you today, Martin?
Pretty good, Alex. How are you?
Very good, thanks. I appreciate you coming back. And that housing episode we did has well over 20,000 views now. It appears everyone wants to consume this sort of content. So I thought we'd do maybe a monthly segment with your top 10 data points or trends. So the first one that you had was days on market, was the first one that I would love you to discuss.
Yeah, so that's an interesting one because, of course, what it tries to do is to tell you what the stock position is. In other words, how many people are trying to sell, and how many of those transactions are actually successful or not. And this particular one is for Sydney from CoreLogic. But what it highlights is a very significant uptick. And we're seeing this pretty much in all markets, even in Hobart now. So two things are happening. Firstly, properties that are for sale are not selling as quickly. So it goes from sort of maybe 25 to 50 days, so nearly doubled in some places. And the number of new properties coming on the market is a little bit down. But because of this legacy, you've got this overhang of property. Now, that's a very important leading indicator, because what that says is that it's now not a seller's market, it's a buyer's market.
And that kind of rolls into that next one, which is auction clearance rates. And we don't have a lot of auctions in Tasmania, but we're noticing this trend on the mainland.
Yeah, so auction clearance rates are a little bit fickle because, of course, it only tells you the proportion of successful auctions. And we know that the total volume of auctions is down, partly because there are less transactions, about 20% less transactions compared with a year ago, but also because more people are not using the auction channel, they're using the private sale channel, because actually you don't have enough interest for auctions. But the clearance rate's also quite interesting, because some of the modelling that we've done suggests that once you get a clearance rate below 50%, that is a leading indicator of more home price falls ahead. And we're bumping around the 40% mark at the moment, which means that we're well under a clearance rate level that would in any way support home prices. So another indicator that prices are going to continue to head south.
And for those at home that might not be aware, that's a very Australian thing, isn't it? These auctions. It's not a big thing in Europe.
It does vary, but essentially, it's a Sydney and Melbourne thing, actually. Mostly it's these big East Coast markets. And in a rising market, what you tend to find is that there's a whole load of interest, and of course, then the price gets talked up. But of course, in a falling market, you just don't have the same interest. And I've actually spent a bit of my time over the last few Saturdays visiting auctions, turning up and watching no bids at all. Well, the auctioneer makes a bid, but there's no real interest and no sales. And so we're seeing a very high proportion of auctions now, even if they are run, get no return at all. Or indeed, if they don't choose to go to auction, we see a lot of withdrawals in the week prior to the auction. So that's something else happening. So I suspect we're going to see auctions become less important going forward.
And that leads into the next one I want to talk about, which is mortgage stress. So a lot of people are coming under stress now, trying to sell their homes, and they're not selling. So what are the mortgage stress indicators telling us?
So mortgage stress is the DFA special, because we use our household surveys to test this, and we look at income and expenditure, and we try and judge whether households who have a mortgage are able to make those repayments from cash flow. And we've now got the situation where 30.9% of all households across the country are actually having difficulty meeting those mortgage repayments. And if you look at the yellow line on that chart, you can see that the trend is very significantly up. In fact, it sort of dropped off after the GFC, when rates were cut and where demand got quite strong and lending standards got loosened, I should say. But now lending standards are tighter. We've also got flat incomes, rising living costs, put all that together, and more people are struggling. And this is a very important leading indicator. This is probably my top pick in terms of, if you want to know what's going to happen to home prices, look at the mortgage stress charts. As mortgage stress rises, property prices tend to fall.
Yeah, we'll touch on a few of the other economic data points towards the end. But am I right in saying that when you go an even more granular look at mortgage stress, it was pockets that you wouldn't suspect to be the weakest first that are weakening?
Yeah, so you expect to find the typical sort of external areas around the major cities, places like Campbelltown and Liverpool, those sorts of places in New South Wales, and I guess to the west of Melbourne, down towards Beaconsfield, those areas as well, looking in Victoria. But we also see some other places too, including some regional centres like Ballarat, for example. But then if you look more closely, some more affluent households are also struggling. And so, for example, we see pockets of stress in places like Bondi. On Toorak, you wouldn't expect it there, but there what we're seeing are people who've bought probably high-rise apartments at the top of the market with big mortgages and are now having difficulty servicing those mortgages. And in fact, what I talk about is what I call affluent stress. So this is where households who typically you'd expect to be fine are not fine because they've got these big mortgages, big commitments, and now are finding it difficult. And some of them are also switching from interest only to principal and interest loans. I'll get it right.
Yes.
Some of them are switching from interest-only loans to principal and interest loans, and that's put their repayments up by 40%. So I think we should be looking not just among the battlers and the urban fringe, but we have to look at the more affluent areas too.
Yeah, now we want to move into some of the broader indicators for these people that are seeing downturns, and that's financial confidence.
Yeah, so that's another of our particular measures. So one of the things that we ask about is how households are feeling about their finances. So we ask about income and expenditure and cost of living and employment prospects and what they think house prices are going to do, and also what their overall net worth is actually faring. And what's fascinating here is we've now got a measure at 87.8, which is as low as it's been since I've run the series, which is maybe surprising, but maybe not. So what that tells us from the more detailed responses is people are really struggling with regard to their cost of living, and they talk about things like electricity costs and childcare costs and healthcare costs and even costs of food. And whilst petrol prices have dropped a little, that's really not offsetting. For many, electricity prices, particularly in Queensland, is a big deal. And then you've got things like they feel less comfortable about their mortgage because the mortgage is big. In some cases, interest rates have risen. In some cases, they're finding it difficult to service it. On the savings side, we're seeing that people are saying, well, the banks are cutting my savings rates a lot. That's, in fact, how banks are squaring off their margins at the moment. So a lot of people are getting less income from their savings, and about 1/3 of households rely on income from savings just to cover their costs. And then, of course, the home price falls that we're seeing in most of the major centres now are actually having a significant impact on people's net worth, plus the fact that the share markets are down, so that's having a negative impact too. So put that all together, and we definitely have households feeling significantly less confident than a year ago, which of course doesn't bode well for retail coming up to Christmas.
And also for the banks, as their confidence drops, the next data point is that interbank funding rate. They're starting to view it as more risky lending each other.
Yeah, so this funding rate, and this is the BBSW, which is a way of trying to get at what the banks are feeling in terms of their funding. So, banks take a lot of their funding sources from overseas markets and from the interbank markets. And so the cost of money between banks is a very important leading indicator of what's going to happen. And you can see from this chart clearly that on a moving average basis, rates continue to rise. Now, the banks have repriced some of their mortgages up a little, but that's not sufficient to cover all of the costs of funding, and fundings are continuing to rise. We expect the US Fed will also continue to hike rates, maybe a little more slowly now because of the wobbles on the stock market. So effectively, banks are sitting on a time bomb with regard to their funding. What they're doing at the moment is trimming returns to depositors because they daren't lift mortgage rates because of the publicity they get. But I think at some point mortgage rates are going to go up further.
Yeah, and that's been quite aggressive from the US Fed. It's caught a lot of people by surprise, and obviously our banks have been caught by surprise. And I did a detailed video for our members about that inverted yield curve because of how aggressively they have raised rates. Yeah,
well, the inverted yield curve is a harbinger potentially of a recession, and typically it happens 12 to 18 months down the track. And the fact that the US rates now look as though that's where they're heading really does give us a leading indicator of problems in the US. And I suspect it's going to be about the debt bomb in the US. A lot of corporates have got huge amounts of debt at very low interest rates. That's going to have to be reset over the next 1 to 2 years. They will be at higher rates. That, for me, is one of the critical triggers we need to watch.
Beautiful. So the next thing I wanted to talk about was the income to savings ratio, as houses do feel the pinch. You already touched on this, that they are digging into their savings and they can't do that forever. So what's that ratio looking like?
Yes, so this is a really important one. This is from the ABS and it's from the most recent accounts. And the savings ratio is really, really important because it tells you two things. One is how much people have, put away for a rainy day. And secondly, what their thinking is with regards to how secure or insecure they feel. So typically what you expect to see, if people are feeling really insecure, the saving rate goes up because essentially they put more money away. But in this case, the saving rate is going down. It's actually as low as it's ever been. And the reason may partly be because interest rates on savings are very low, but our surveys suggest that the major reason why the savings ratio is so low is that people are being forced to draw money from those savings just to cover day-to-day expenses. And this is coming through from the mortgage stress as well as from the ABS data. So to my mind, the low savings ratio is not an indicator of high levels of confidence among consumers, which is in fact what the Treasurer said the other day. It's much more to do with simple arithmetic. I need to find funds to be able to actually cover my cost of living, and I can raise savings when I've got them. But of course, you can't go on raising savings forever. So my expectation is that the savings ratio will continue ever lower until such time as wages start to recover, and that probably won't be anytime soon. So this is an important leading indicator.
Yeah, I think the next indicator builds on top of that as people are tapped out and digging into their savings, and that's credit growth. People aren't wanting to put daily items and go into more debt when they're already digging into their savings.
Yeah, so the credit growth data is really fascinating because it's important to understand we need to think about credit momentum, right? Because it's the rate of change of credit that actually has the strongest correlation to impact on the economy or home prices. And so if you look at the change of credit over the last few months, and this is the RBA statistics, you'll see that credit is growing, but it's growing at a lower rate. Now at 5.1% for home lending compared with 6 or 7% then. And that credit momentum, or sometimes it's called the credit impulse, as it's slowing, has a very significant negative impact on households and on home prices. So that's the first point. The second point is personal credit is well below the waterline. So another sign of people's confidence is they borrow more and are comfortable because they know they can pay it back. The fact that we've got personal credit dropping is quite significant. And then the final point here, this chart also includes business credit. Now, the Reserve Bank always had the view that they would use household consumption for 4 or 5 years to try and wean us off the mining boom and get the commercial sector to be firing. But the data here shows that even now, the commercial sector borrowing levels are still quite low. It's growing up a little, 4.7%, but it's still quite low. And so we've got a lot of businesses that are actually still struggling and either can't get finance or don't feel confident enough to get finance. So these are all indicators of, again, more difficulties ahead.
I just want to drive home that first point you touched on then for people that may be just getting their heads around this for the first time. So credit can continue to grow, but if the rate that it is growing slows down, that alone can lead to a recession, which is very, very scary stuff.
Yeah, it's the credit impulse is the key phrase, right? So it's the rate of growth of credit. And as credit decays, even if it's still growing a little, and it will because of inflation and because people are refinancing and all doing all those things and pulling more equity out. But if the total growth rate is slowing, that is sufficient to kill house prices.
And that leads into the next point I want to talk about, which is that wage growth. So it's all good if we've got a lot of debt and big mortgages, but it's not getting easier for these households if their wages aren't going up, and they've been stagnant for quite some time now.
Yeah, so this data is actually, again, from the ABS, and this is a snapshot, but the point there is that if you go back to 2012 in real terms, there's been no growth in real incomes over that time. And in fact, there's been a drop of 0.4% on average. Now, more affluent households have done a little better. compared with those at the bottom end of the spectrum. But wages growth is a really big deal because essentially, despite the fact that we've got relatively good employment and relatively low unemployment, the real impact on households is that their incomes are just not growing. And that's one of the reasons why mortgage stress is rising and the other factors here. So the fact that wages even now are still anemic shows me that we've still got significant issues in the economy.
Yeah, and again, for those people at home that might not be familiar with the term real growth, if inflation is trending at 2 or 3% and you might get a wage rise of 1 or 2% a year, you're actually coming out behind and losing purchasing power every year.
Correct. And in fact, if you want to try and beat the inflation rate, then you need to work in the public sector in Canberra because they're doing quite a lot better than most other places.
Yeah, or work on the stock market where they're aiming for between 7 and 10%. Otherwise, they feel that they've lost out.
Well, some of those big bonuses aren't being paid at the moment. So
this is probably our broadest measure, GDP per capita.
Yeah, so GDP is an interesting measure, and it's an interesting question as to whether it really tells you the right thing. So GDP was a measure sort of developed after the war. It tries to understand the total contribution of the economy, right? And the GDP in Australia has fallen away a little bit. The Reserve Bank was thinking that GDP for the year will be well above 3. On the results that we've just seen, it's probably unlikely to be that strong. But GDP takes account of the total activity without taking any reference to effectively the number of people. So in other words, if you bring more people into the country, GDP goes up, right? The real important measure is GDP per capita. In other words, what is the contribution to growth that each individual has actually made? And that is tanking. And that tells us that we have a really significant problem in Australia with overall production and overall growth levels on a per capita basis. And in fact, the only reason why we've got GDP growth is migration and more population. And that's a pretty important factor to bear in mind. Bearing in mind also that it's the household consumption sector that's been one of the strongest contributors to GDP over the last 4 or 5 years. Now, from the early indicators, we saw that sliding away now. So on a GDP per capita basis, I'm expecting to see more weakness ahead.
So again, to explain this one to people at home, our GDP, the size of our economy might be growing, but if we've had a heap of people move here that are young, fit and healthy, that should be doing a lot better and getting better jobs and making more money and spurring, their job to employ someone else and getting that money flow and all these sort of measures. But we're kind of kidding ourselves saying, the economy's growing a little bit. It should be doing a lot better.
That's exactly right. And in fact, the government sort of fixate on the employment rate being very low, and we're close to repaying our net debt, on a flow basis. That doesn't deal with the historic debt. And they quote the GDP number as being reasonable, but frankly, it's very myopic. And there are a lot of other indicators that we've discussed here that suggest that things are not as well as perhaps the government would like to present.
Yeah, so the final point here in tying this all together is the number of rejections. As you mentioned, there's a number of people coming up from interest only to principal and interest, and the record amount over the next 3 years for all these people that tried to lock in low interest rates a couple of years ago. It's coming up time to renew these, and everything going on with the Banking Royal Commission. People are coming under a big microscope that they weren't previously when it comes to checking out their personal finances and getting a new loan.
Correct. Yeah, this chart again is from DFA data from the surveys. And if you look at the right-hand side of the blue bars, that's the total proportion of loans rejected in the system each month, right? And if you go back a year, it was knocking around the 5% mark. We're now at 50%. So what that means is half of the loan applications that are actually being put through the system at the moment are being rejected by the banks. And these are mortgages we're talking about, right? And that's because income is not being adequately stated appropriately, or more likely the costs that are now being looked at very forensically are not able to support the level of loan that people have previously. So a lot of people who have a big loan try and get it refinanced and get kicked back. New borrowers now find that effectively they need 6 months of history to be able to actually get those loans approved. And it's also then, if you look on the other side, on the left-hand side, you'll see there that it's actually the refinance guys that are actually the biggest driver of the increase. So that sort of orange or red line shows you that it's the refinance guys. And a lot of those people, as you say, are trying to switch from interest only to principal interest loans. Quite often they've got investment properties. And the other point there is that even some of the other groups, the ones who would normally be able to get like investors, are also having the same challenge. So pretty much across the board, it is way tougher now to get a mortgage. And it's worth thinking about the timing of this, right? So if you think that the Royal Commission effectively started, in February, within 3 months of the Royal Commission starting, we suddenly found this, and now we've got these very high levels of rejection rates. And frankly, I don't think that's going to change. So I think we're in a new world when it comes to loan applications. The amount of time and effort and processes and the number of rejections will continue. Final point, if you look at rejections from the non-bank sector, they're a whole lot lower because their lending standards are a lot looser. So effectively, whilst they might be a relatively small proportion of the total market, in fact, it is the main lenders, the ADIs, the banks, who actually are rejecting more loans.
And this goes full circle, and we're going to be doing this every month for you guys to see how the data is changing. But this goes full circle back to the top of the list that we just started on about once these people are getting rejected, then there's more houses to sell, and then we're back to days on market and clearance rates and so on. So hopefully you guys have enjoyed this segment. I know I've got a heap of questions about the Australian economy if you'd like us to do a specific episode on that, as well as the housing market. But thanks for joining us, Martin. I've really enjoyed this monthly housing update, and thanks for everything you do. I'll put the links below to how you can support Martin. But thanks for joining us again today.
Great. Good to talk to you, and hopefully we'll chat again.
Cheers.